Welcome, friends, to our channel. Give yourself a raise where we help you make smart money decisions. Imagine a way to invest in the stock market that's simple, low cost, and has a history of strong long-term performance. That's the power of index funds. But what are index funds exactly? Well, they're a type of mutual fund or exchange-traded fund that aims to match or track the components of a financial market index, such as the S&P 500. This means they provide broad market exposure, keeping expenses low and portfolio turnover minimal. It's a kind of passive investing strategy where you're not meticulously picking out individual stocks, but instead, you're replicating the performance of an entire index. This simplicity and cost-effectiveness make index funds a popular choice for retirement accounts. So remember, with index funds, you're not trying to beat the market. You're simply trying to be the market. Index funds didn't just appear out of thin air. They have a rich history dating back to the 1970s. So, let's hop into our financial time machine and explore the origins of these investment vehicles. The year was 1975. The financial world was abuzz with a new invention by a certain John Bogle, a man who would later become a legend in the world of investing. He had just founded the Vanguard Group, and with it, introduced the first ever index fund to the public. This fund, named the Vanguard 500 Index Fund, was designed to mirror the performance of the S&P 500, one of the major stock market indices. The idea was simple and revolutionary at the same time. Instead of trying to beat the market through active management, why not just match it? This concept, known as passive investing, was met with skepticism initially. Critics called it un-American, and Bogle's fund was even dubbed Bogle's Folly. But Bogle was unfazed. He believed in the power of simplicity, low costs, and long-term investing. And he was convinced that his index fund, by broadly tracking the market at a lower cost than actively managed funds, could provide solid returns for investors over the long haul. Fast forward to the present day, and it's clear that Bogle's idea was more than just a folly. Index funds have not only gained widespread acceptance, but they've also transformed the world of investing. Today, they're recommended by financial gurus and endorsed by investment titans like Warren Buffett. Trillions of dollars have been poured into index funds, and they've proven successful in outperforming most actively managed funds over the long term. The success of index funds over the years has proven that sometimes simplicity and patience pay off. Now that you know what index funds are and their history, you might be wondering, how do they actually work? Well, at their heart, index funds are a form of passive investing. Instead of trying to beat the market with clever stock picks, they simply aim to replicate the performance of a certain benchmark index, like the S&P 500. Think of it like this. If the stock market were a vast forest, buying individual stocks would be like picking and choosing specific trees. But with an index fund, you're essentially buying a small piece of the entire forest. This gives you broad market exposure, allowing you to ride the overall trend of the market rather than banking on individual companies. But what about costs? Well, index funds have a major advantage there too. Because they're not actively managed, they have lower expenses and low portfolio turnover. That means less of your money goes towards fees and more stays invested, potentially growing over time. That's the beauty of index funds. They give you a slice of the entire market, all in one neat package. Scene script. Like any investment, index funds come with their own set of advantages and disadvantages. Delving into the pros, one of the biggest draws of index funds is their simplicity. They're designed to match or track the components of a market index, such as the S&P 500. This means you're not placing your bets on a single company or sector, but on the entire market. This approach provides broad market exposure, which can be a boon for those who aim to diversify their portfolio. Next up is cost effectiveness. Index funds are a form of passive investing, which involves less buying and selling of securities. This results in low portfolio turnover, and consequently, lower expense ratios. In the long run, these lower costs can make a significant difference in your investment returns. Moreover, index funds have a history of strong long-term performance. They've outperformed most actively managed funds over time, making them a favorite for retirement accounts. Even the Oracle of Omaha, Warren Buffett, has endorsed index funds as a solid investment choice. Now let's pivot to the cons. Despite their many benefits, index funds are not immune to the swings of the market. When the market takes a hit, so does your investment. This vulnerability to market volatility is something to consider. Another potential downside is their lack of flexibility. With an index fund, you're locked into the holdings of the particular index you've chosen. This means you can't switch out underperforming companies or sectors as you could with an actively managed fund. While index funds aren't perfect, they're a solid choice for many investors. But as always, it's important to do your own research and consider your own investment goals. So, there you have it, a crash course on index funds. We've journeyed together, unraveling the history of index funds, how they work and their pros and cons. We've discovered that these funds are a form of passive investing, aiming to replicate the performance of a benchmark index, offering broad market exposure, low expenses, and low portfolio turnover. Yet, it's crucial to remember that like every investment, they have their vulnerabilities. They're subject to market swings and lack the flexibility of active management. And while index funds have been successful in outperforming most actively managed funds over the long term, past performance is not a guarantee of future results. It's always essential to do your own research, understand your financial goals, and consider your risk tolerance. Consulting with a financial advisor before making any investment decisions can provide additional insight tailored to your individual circumstances. If you found this video useful, please leave a comment below and let us know what other money topics you'd like us to cover. Remember, investing is a journey, and we're here to guide you every step of the way.